Today we will find out why the stock market is a device for transferring money from the impatient to the patient. This quote from Buffett underlines today's market expectations best and lets us deep dive back into the year 2000 and find out why this time it's no different. We jump to the year 99, where Oakley sunglasses, Walkmans and the Casio G-Shock watch were popular, while millions of people watched The Matrix in theaters and sipped good old Coke Classic. Besides pop culture, the stock market went from fairly valued to overvalued to highly overpriced. In normal market periods, the S&P 500 increases by 10% on average per year and thus doubles about every 7.2 years. From start of 1995 to end of 1999, the S&P 500 jumped by over 215%, meaning it more than tripled its invested value in just 5 years, which is more than unusual in such short time period. The price-to-earnings ratio of the S&P 500 surged from around 14.5 to over 32. As you know, this development was far from being sustainable and healthy. It was led by speculation, fear of missing out, and hype. And the catastrophic crash in 2000 and the following years was brutal to the stock market. Companies like Pets.com, eToys.com, and yes, even prominent names like Cisco dominated the market news. The following years of 1999, the S&P 500 dropped by 48%. And the technology-driven Nasdaq faltered by 78%. As you can see in this graphic from the Wall Street Journal, the Nasdaq took over 17 years to recover from the peak of the dot-com era. Meanwhile, Pets.com and eToys.com both went bankrupt, while Cisco dropped almost 90% and only reached the dot-com price levels 23 years later in 2022. That's why Benjamin Graham warned investors with, quote, "While enthusiasm may be necessary for great accomplishments elsewhere, on Wall Street it almost invariably leads to disaster." So should we all buy bonds and be happy? Certainly not, but it's important to remind and prepare yourself for a once-in-a-decade opportunity. Yes, opportunity, especially why this time it's no different. Currently, the S&P 500 is trading at a median PE ratio of 29, which is of course heavily influenced by big tech companies. Just to give you a glimpse into the numbers, these are the PE ratios of the top 20 positions of the S&P 500, marking about 50% of the whole index, listed with its weight in the index. The average PE ratio of just the top 20 with regards of their corresponding weights is about 57. If you're a defensive, long-term investor, you should always stay invested with your passive portfolio, but one might be prepared to buy bargains when panic starts. And yes, even today there still exist bargains, which can be found by digging through the news and filtering prominent overvalued stocks. So here are 6 different quality stocks, all facing strong headwinds and low valuations at the moment. Procter & Gamble is currently trading at a phenomenal 8-year low PE ratio of 21, has dropped by 17% from its last peak, and pays a dividend of 2.92%. The same accounts for colgate-palmolive, as this stock trades at a PE ratio of 22.3, which is 13% below their 20-year median of 25.4, with a maximum drawdown of almost 25%. And a dividend yield of 2.61%. Besides classic value stocks, there are Canadian Railway, trading at a PE ratio of 18.3, which sits below its 10-year median PE ratio of 20 and has a maximum drawdown from peak of currently 21%. Plus, Canadian Railway pays a dividend of 2.63%. SLB, the oil and gas equipment company, trades with a PE ratio of 14, which is 37% below the 10-year median PE ratio of 22. Kimberly-Clark, the producer of Kleenex, is also currently below its 10-year median PE ratio of 17.1, is 30% down from its last peak, and is paying a massive 5% dividend yield. Another option, if you still want to play the growth stocks, Netflix is currently on discount since it's down by 30% from its last peak in June 2025. Yes, its PE ratio is lofty when thinking as value investor, but compared to its historic median PE ratio of 57, it seems reasonable. Alternatively, think about building a good amount of cash, like 20% or 30%, to jump back in when panic signals trigger, as we explained in our last video. Warren Buffett's Berkshire Hathaway is currently piling up cash, with current numbers reaching over $380 billion, meaning Buffett currently holds cash more worth of Procter & Gamble, Coca-Cola, or about 90% the market cap of Netflix. As we don't exactly know Berkshire's motivation holding cash, it might be the transition from Buffett to Greg Abel as CEO of Berkshire, or not finding bargains at the moment. And yes, even Berkshire is still buying stocks, as they invested $4.3 billion in Alphabet in Q3 2025. Instead of overreacting and panicking, we have to stay grounded and humble. This video should definitely not trigger you to sell any of your long-term investments. Instead, it should help you prepare mentally for the next stock market crash, because if you're mentally prepared for a storm, you can decide more rationally and trust your long-term financial decisions to stay invested while everyone else is in panic. And if you're extra prepared, you most likely will bring up the courage to buy more stocks during a crash when stocks are bargains. Therefore, here is a preparation list one can do. Hunt for stocks which are currently overvalued, but you think they have a long-term moat. Set a concrete PE ratio or even a concrete price point at which you want to buy them. Set a price alarm or even set a limit buy at your wished price target. And last but not least, pile cash at 20% rate of your active portfolio, while 80% stays invested. The combination of passive investments in ETFs plus an active investment via buying stocks on discount is one of the golden combinations for a private investor. While ETFs keep you invested even in the stormiest crash, the active portfolio lets you buy bargains when panic hits the market. Thanks for watching and see you on the next one.